Well, hi everyone. Shaun here. Welcome to the presentation, Questions to Ask About Your Pension Plan. I put together this particular presentation because I think there's some critical questions that we need to be asking, you need to be asking about your pension plan so that you can effectively plan for your own retirement. These questions come out of over 30 years of working with clients on various aspects of retirement income planning and literally walking hundreds of families through these very important discussions and decisions. So once you have the answers to these questions, then you can develop a holistic plan around your retirement income. So let's take a look at some of the key questions, and this is not necessarily exhaustive, but I think it covers the main questions that we need to begin asking. And then once you've sort of got the questions, it's important you seek out the answers if you don't know them right away. Talk to your benefits director, your pension specialist at work, and they should be able to either answer the question or direct you to an appropriate source. So how much will I receive as a retirement benefit? That's the initial question. You know, you get statements likely every year, at least I hope you do. And when you do, there's usually some estimate about that benefit. But what you find is there's not a universal sort of systematic way of reporting these benefits. It's a little bit helter-skelter. So the first thing you need to do is to find out from your benefits department, what assumptions are they using in calculating that benefit? Also, make sure that the data they have for you as an employee are accurate. Do they have the right number of years of service, as an example? So just understand how they're calculating the benefit. That might throw up some red flags if you think some of the data they're using isn't accurate. But the first step is just get into the statement, find out what the benefit is, ask questions about how that calculation is arrived at. And as we go through the rest of the questions, that'll sort of bring some additional context for the kind of questions you need to be asking. How much is contributed to my pension plan every year? That's an important question. I think for defined benefit or formula plans, that's important because the amount of money going into the plan really drives how well funded the plan is. Is it fully funded? Does it have enough money to back up the future pension commitments? So that's an important consideration. Number two, if I'm part of a defined contribution pension plan. That's a pension plan that there's no real guarantee on what your pension will be down the road, but what's happening is you're putting money in the plan, the employer is putting money in, it's being matched usually, and then the money's getting invested. Sometimes the employer does that for you, or very often you have to make investment options. That money will compound and grow, hopefully, and then when you retire, you can produce an income with those assets. So obviously you need to know your contributions and your employer contributions to do an accurate or fairly accurate estimate as to what your future pension will be with a defined contribution pension plan. Very important question. Will my pension plan be affected by my government benefits? And we'll talk about a couple of ways that this can happen. So I would float the question past your benefits department or administrator. Look at your benefits booklet. Sometimes it's not as clear as we would like when we look at the information for clients. But you know, sometimes pension plans are integrated with government benefits. A classic example is the federal government plan here in Canada, where civil servants, when they retire, if they retire early, let's say before age 60, let's say at age 58, they get a pension, and that pension will continue. And then at age 65, there's an integration with Canada Pension Plan. So the superannuation or pension will drop, and then what makes up the difference is Canada Pension Plan at that point. So sometimes employees think that pension is just going to be a linear kind of straight line number, but that's not always the case. That integration can take place with many pension plans. Is there integration with government benefits and a bridging option? So I just talked about that a little bit, the integration of benefits. Bridging options are a little bit different. That's where an employer might give you a little bit of extra cash as one of your benefit options to sort of bridge the first few years of retirement when you're younger, maybe you still have expenses, particularly if you retire earlier. Kids may still be at university, maybe you have aging parents, there's other expenses. And so they'll give you extra for the first few years, let's say from age 58 to 60, from 60 to 65, and then you have your basic pension. Now sometimes when they give you a bridging option, they'll giveth, but they taketh away down the road. So you find that your pension plan may drop at age 65. If that happens, it's very important that you crunch the numbers. Either you do it, I'd recommend you have a financial planner do it, to find out whether bridging really is a good long-term financial option for you. But the bottom line is, ask if there's bridging, what the options are, how that might impact your pension plan. What happens when I retire early? Sometimes this is referred to the magic 80, and really the magic 80 is a number that's important because if you retire too early, there can be actuarial penalties. In other words, they're saying this is a really early retirement. We can't pay a normal benefit because you can have a long life expectancy. So Magic 80 is an example. We'll take your age and your years of service, and if they add up to 80, there'll be no actuarial penalty. So ask the question, find out what the formula is, find out whether you'll be hit by an actuarial penalty, and if you are, you can start making decisions. It could be, well, then I'll just defer. I'll defer for the 2 years, then I'll retire. Or I'll retire early anyway, but I'll defer taking my pension for a couple of years so that it's not hit by a penalty. Or I might look at other options as well. Maybe I'll just save more. I'll retire early, be hit with a penalty, but I'll use my other savings to subsidize the difference. So there's no right or wrong here. You just need to understand what your options are in this particular context. If my pension plan is a defined benefit or formula plan, what is the specific formula used in calculating the pension? Well, you probably already know the formula if you're part of a defined benefit plan, but again, not everyone's clear on this. So a Cadillac plan is 2% times years of service times the average of your best 5 years working with that organization. It could be a 1% benefit rate. So it varies depending on the organization. The other thing that happens is sometimes this benefit rate can change. So we sometimes see that benefit rates, yes, they're 2%, but up to a certain income level, the benefit rate might be 1.4%, and then above that income level, it'll be a 2% benefit rate. So in our jurisdiction, I'll give you an example. So let's say that the yearly maximum pensionable earnings for the purposes of Canada Pension Plan contributions is $50,000. Well, a lot of employers might go, well, listen, we don't think we need to pay a full benefit rate of 2% when you're getting Canada Pension Plan. So we'll give you the 2% benefit rate for every dollar of income above what you're contributing in terms of building up pension value with Canada Pension Plan. And for my discussion here, that's $50,000 a year. So the employer will do 1.4% times $50,000 per year times years of service. And then they'll do 2% times years of service times whatever income's above the $50,000. So if I'm making $70,000, that 2% rate will apply on the $20,000 above the $50,000, but it doesn't apply on the full $70,000. So again, ask the question, what are the benefit rates? Is there any integration with government benefits? Or is it a flat benefit rate of 2% or 1.5 or 1%, whatever the number is, on all income from $1? So make sure you ask that question. Does the company provide any other retirement benefits? Well, those could be things like life insurance benefits, group health benefits, travel health benefits. You may not need these benefits, particularly as it relates to life insurance, but often, particularly when people retire early, they still may need some life insurance to cover some needs that might be outstanding for beneficiaries, for loans. There could be other things outstanding. The other issue is that sometimes people, obviously as they get age, become older, they become uninsurable. And so they may have the option with their group plan to continue carrying life insurance without proving insurability. So again, just ask the question, what are the benefit packages? What can I continue carrying after I retire? Before you retire, can I buy back any past service? And this relates to situations where you've been working for a number of years, but it's not uncommon that for the first 2 or 3 years, you may have been on a probationary period and you were not fully participating in all of the benefits package. So in this circumstance, you might be able to buy back that 1 or 2 or 3 years of service. Maternity leaves, maybe a leave of absence. So there's various things that might qualify. The question you need to ask is there any past service I can buy back? The second question is, can you do a calculation as to what the cost of buying back that past service is? And then once you have that number, you can sit down on your own or have your financial advisor work out the numbers to confirm whether in fact buying back that past service makes sense for you. So in some circumstances, it can make a lot of sense. In other circumstances, it can be quite marginal. Often with buyback, you can even use your own RSP capital. You can transfer that tax-free to the pension plan to buy back that service. So again, very important question to ask. When I retire, is the pension portable? That just means, can I take the vested value, or sometimes what's called the commuted value, and just transfer the pension plan into my own accounts, often referred to as a LIRA, or a life income fund, or a prescribed RIF, and manage that portfolio on my own. So many pension plans do not allow that portability, but you want to begin asking that question early so you can plan accordingly. There's pros and cons to accessing portability and taking commuted value. It's not for everyone, but it is an important question that you have clarity on. Is my pension fully funded? Well, at the end of the day, you may not be able to do anything about this one, but fully funding means that if I have a defined benefit plan, that formula plan we talked about, Is there enough money in the plan to fully fund all the future pension benefits? That's more of a peace of mind issue, and you want to understand sort of what behind the scenes things are going on to make sure that pension is fully funded if it's not. And then you sometimes see individuals really getting serious about their own group RSP plans or their individual RSP plans and investment portfolios, tax-free savings accounts, to play a very good diversification role. If the pension plan's are really struggling, there's been deficits, and the company's been very inconsistent in funding some of those deficits, then I think it would be prudent to not fully rely on that pension plan's ability to follow through, at least to follow through in the way that it had originally promised to deliver. But in the end of the day, there may not be a lot you can do in this, but I think it's an important question that you ask, so you're not blindsided just before retirement, and now you have no time to really play catch up on the pension plan not really honoring what you thought it would do for you. If defined contribution, what are my investment options? So I alluded to this before. With a defined contribution plan, again, you're putting money in, your employer is usually matching, and you have to invest some money. More often than not, you're charged with making those investment option decisions. So you want to get clarity on those options. You should sit down with your benefits department specialist to understand how the options work. If you don't have that option, be sure to sit down with your financial planner and integrate your group benefits information with your own personal planning. And your financial planner can play a role to bridge those two so you have an overall plan that makes sense, it's consistent, it's fully integrated between your personal investment choices and your group investment choices. What are my survivor benefit options and how do they work? When you plan retirement, it's not a solo effort. If you have a partner, one of the issues, all pensions jurisdictions do have statutory requirements, regulations to ensure that the survivor, your partner, is given survivor benefits. It could be in the form of an ongoing income. It could be in the form of what's called cumulative value that goes directly to the survivor. So again, you just want to start asking questions about what the benefits are, how they work, what the trade-off decisions are, and then if you have any questions or you need further sort of sober second thought about what option is best for you, sit down with your financial planner and they can give you some counsel on that. Is there a cost of living allowance and is it contractual? So some pension plans will initiate ad hoc indexing. So once you retire, if there's some inflation, over time there'll be a little bit of an increase. Ad hoc means there's no contractual commitment. It's often a function of how healthy the pension plan is. And if you have a private pension plan and it's not a fully funded plan, then pretty much guarantee that you're not going to get cost of living adjustments. If you're part of a federal government or provincial government or crown corporation plan, likely there'll be cost of living adjustments, and very often they're contractual. Now, they may not be contractual from $1 of inflation, which means that if the consumer price index goes up by 3%, you can't necessarily expect a 3% increase. The contractual obligation might be CPI, consumer price index, less 2%. So that means if the consumer price index in my example is 3%, then you're going to get a 1% increase. So it's not from $1, it's at a certain threshold that those increases begin to take place. But it's a great benefit to have. If your income can be mostly kept in pace with inflation, that's one less thing that you have to worry about. Well, those are some questions to begin asking as you sit down and prepare your own retirement income plan. So I'd encourage you to go through that list again and start jotting down the answers to the questions, and then use your HR director, benefits consultant through your employer as a resource for those questions. Once you have the information, if you have an advisor, I'd really recommend you sit down with them, and they'll help to give you clarity and proper context on how your pension plan fits into your overall retirement income plan. If you want more information about our services, don't hesitate to visit our website at www.shaunhumphries.com. You can touch base with us by calling us at 204-977-8049, or feel free to zip me an email at shumphries@asante.com. You take care.